All right. Good afternoon, traders. Uh, Dennis. Welcome out, everybody, to the Tradespoon Tradespoon Active Investor Workshop series, which is scheduled to start at 3:34 p.m. Central Time. So I was right on time, as always. Dennis thought I was late, but no, that's not true. Welcome out. My name is Scott Beck. I am the head trading coach here at Tradespoon. I look forward to these Tuesday presentations. Welcome back, Dennis. Thank you. Hello, Ash. Hello again to you, Phil. Good to see me right on time. Exactly, right on time. We start right when we're supposed to. The cosmic forces at play dictate when I start. It's not me. I don't get to pick. It just comes. That's it. Beck Standard Time, Dennis. That's it, 100%. Glad you guys could make it out with me today. Welcome to the Active Investor Workshop Series. As I said, I am the head trading coach here at Tradespoon. A little background on me. I have been trading for going on, 21 years, almost 22 now. I got to update my slides. I've been teaching for about 17 years now, and I very much love what I do. I do need to remind you specifically that trading and options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk. Be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. It should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education and information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin, interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team at Tradespoon may have a financial interest in the securities presented and the trade picks. Vlad Karpel, Tradespoon founder, is also an investor and consultant of AOS Inc., which does business as Trading Block and Money Block, a FINRA and SIPC member broker-dealer firm. Tradespoon and AOS are not affiliated companies. Each firm's material is not endorsed by the other. Okay. So, full disclosure, this is a new one for me. I've been doing these for, 3 years now. But today's presentation is a new one, and I reached out to Vlad and said, "Hey, do you have a slide deck for this?" And he did not. He had an old video presentation of it. So I'm winging it. We're talking about options expiration. Do we roll? Do we close? Do we take a loss? And even if I had slides, let's be honest, there's just a lot of considerations. There's no like, this is the rule. If this, then roll. If this, then close. There's a lot of factors that will go into that decision. That's what we want to talk about today. So, a couple of things. First and foremost, back to the disclosures. If you've never gone in and read for real characteristics and risks of standardized options, which is something that you have to tell your broker you have read when you apply for options. And I would imagine that most of you here are approved for trading options, and yet you probably never actually read the characteristics and risks of standardized options. And I get it. It's like, oh, have you read a prospectus for all the mutual funds you invest in? Probably not. Here's what I would say. It's worth it. It's worth it to go through it. It answers a lot of questions that you may not even realize you had about the logistics of trading, about expiration, about assignment, about market close Friday and options actually expiring on the Saturday at midnight, and how assignments occur, and how does it end up with you getting exercised. And there's really just some good information in there that if you've never read it, you would probably be like, oh wow, yeah, that was worth it. So that's the first thing. But today, I want it to be open to questions from the very beginning. because it is a weird thing at options expiration. Many of you may have heard this is such a terribly tragic story. I'm going to close this. Everyone's always like, am I supposed to be seeing some slides? So I'm just going to bring up, we're going to bring up the SPY on the 5. Actually, we're going to watch the simply scared and paralyzed. Well, we don't want that. It is kind of a funky market right now, right? I'll give you that. I mean, we've had this bullish run on the S&P, but we've really seen kind of an interesting shakeout and kind of a grind sideways on a lot of stocks. And so let's talk about it. Expiration. What happens at expiration? Well, it depends if the option's in the money or out of the money. Depends if I'm a buyer or a seller. It depends on what else I have connected. Right? Do I have a single option that I bought or sold? Do I have a spread trade? There is a story that occurred last year. Some of you have probably heard of this. An absolute tragedy of a story of a kid. I mean, technically an adult, but a kid. I think he was 19, who committed suicide. Around an option expiration event. Did you guys hear about this? It was one of the Robin Hood traders, and they did not last July. Is that when it was, Ricardo? Last July. Yeah, okay. It was, gosh, almost a year now. So here was the circumstances, and this will lead us into our discussion today. And I really would love to have a lot of feedback and a lot of questions, and just anything you want to ask about specific scenarios, things that have happened to you and you weren't sure what happened. But let's really get comfortable with expiration. So this person had done a bull put spread. Okay, and this is a trade that we do a lot of in my trading room, bull put spreads. So it's certainly relevant. But he did a bull put spread. In a bull put spread, you have sold an option, and that creates an obligation for you. And you have bought an option, which creates rights. Remember that with options, at any given time, there are buyers and sellers and they're not technically matched up. That's an interesting thing. There has to be a seller, right? So if you're buying an option, who's the seller? It's the market maker, right? Usually the person on the other side of the trade is a market maker. And when you buy that option, you get put into a pool. And if you sell an option, it's usually the market maker on the other side, and they get put into a seller's pool. So there's a pool of buyers and there's a pool of sellers. And the organizers of these pools is the OCC, Options Clearing Corp, right? So anytime there is an assignment or an exercise, if I buy an option and I say, you know what, I want to force this contract. As a buyer of an option, I have rights. I have the right to exercise, the right to sell, the right to let it expire worthless. Those are my rights. As a seller of an option, I am obligated. As long as I am in that contract, I am obligated to the contract. Now, if I sell one and somebody else buys one, it's not like the two of us are connected. I'm in a pool, they're in a pool. And if a buyer decides that they want to exercise their option, they tell their broker goes to the OCC says, okay, and they randomly pick somebody from the sellers in order to assign the contracts. It is a random process. Any assignment or exercising situation that occurs before expiration is going to be random. Other than that, there is a significant amount of exercising around dividends, especially special dividends. Now, if it's a small dividend that it was announced a long time ago, nobody cares. If all of a sudden they announce a dividend, remember that options traders do not have the right to dividends. Only stockholders do. So people who own calls know that the stock is going to drop by the dividend amount when it goes ex-dividend, and they're going to lose value. So the only way they can prevent that is to exercise the option, buy the stock, right? So that's one scenario where there is a higher degree of probability of assignment. The other time is expiration, right? It's at expiration. Now remember that these days, it used to be 25 cents. When I first started in trading back in 99, auto exercising, which is what your broker does, was 25 cents or more. If you had an option that was 25 cents or more in the money at expiration, they would be like, oh, we're going to exercise it for you. And of course, they would charge you an exercise fee, and then you would have to sell the stock, and they're going to charge you a commission on that. It's better now, but that's now if it's in the money at all. A penny in the money. If you own an option that's a penny in the money and you let it go to expiration, at that time, the broker will auto exercise it and buy the stock for you. So those are just some of the logistics that we're dealing with. Now, was it calls or puts? It was puts. It was a bull put spread. So here's what happened. Let's just say that I did a bull put spread here on SPY, and I sold this put and I bought this put. Well, the first one is in the money. That's an in the money put. Someone has the right to sell me a stock at a different price. I want the stock to be, sorry, I have that. No, that's right. That's right. If I do a bull put spread, what do I want to happen? I want it to go up above both strikes, up in this area. Right? That's what I want to happen. What do I absolutely not want to happen? I don't want it to drop down below both strikes. Those are the two main probabilities. And then I have the third option, or the third potential scenario, and that is in the middle. And that's where this one is. So if it's in the middle, the option that I bought down there is going to expire worthless. Okay? It's going to expire worthless. If it had finished up in this top range here, I'm going to put a check mark in it. If the stock finished above my bull put spread, what happens? Both options are out of the money. They both expire worthless. I keep my original credit and I move on. So if it's a bull put spread, worthless, I make max gain. If I did a bear call spread, it would be the opposite. I would need it to go to the downside and close below my bear call. If it closed below my bear call, what happens? Both options are worthless. They expire. I keep the credit I collected when I first put the trade on. Beautiful. Okay, so what happens if it is both below? I'm going to put an X. If both options finish below, right? If the stock finishes below, if both options finish below, they are both in the money. Okay, so what happens there? And what do I have to do? Now, and here's the thing, we'll talk about a roll. And I'm going to give you my take on rolls and tell you first and foremost to be very, very careful. So let's say that both options then are below, or the price is below both options, which means they're both in the money. Well, at expiration, I know for a fact that if there's an in the money option that I sold, it will be exercised. And if I own an option, it will also be exercised. But rather than me exercise my option to grab some stock to then deliver to the person who exercises their option, the options go through a process that is known as same-day substitution, which basically is Peter pays Paul, right? That's what happens. Now, I don't have to do anything. I will be at max loss. Whatever the maximum loss was for that spread trade, I'm there. And that's it. Right now, here's the thing. It's not like all of a sudden I lost more money. I was probably at max loss or very close to it the last couple of days of that trade. So at that point, it was an unrealized loss. But when it gets to expiration and it goes through same day substitution, then I have a realized loss that is the maximum, which in this case would be the width of the spread minus the credit I collected. It would be an amount that I was well aware of, right? So, okay, there it is. The third opportunity or third scenario, I'm going to put a little question mark in this box. What happens if it's in the spread? So I have out of the money, that's for a credit spread, out of the money, good, expires worthless. I have in the money, bad, same day substitution. I don't have to do anything in either of those circumstances. It's the third scenario, and this is what happened. So if you were ever curious what happened with that kid, it was the third scenario. So he had a 10 contract bull put spread on Amazon. Yes, probably over leveraged. What was going to happen was the option that he bought was out of the money, which means it expires worthless. It doesn't help to have an out of the money option at expiration. But the option that he sold was in the money, an in the money option. In the money option at expiration, what do we know is going to happen? Exercise and assignment. And that's what happened. Somebody assigned him. 10 contracts is 1,000 shares. 1,000 shares of Amazon might have been something else. I thought it was like a $700 stock at the time. But it basically turned out to be $700,000 worth of stock. $700,000. And he had like a, I don't know, $15,000 or $20,000 account. So he didn't understand. Like, he thought he was losing the money. He tried to call. They didn't have a lot of information about what exactly happens. And it overwhelmed him. And he ended up taking his own life. I mean, it's really a scary. Now, here's the thing is people are like, oh, what a crazy story. So I was traveling with my daughter on a soccer tournament. It was a Sunday. And I had dropped her off to warm up, and I was just walking around the fields, and all of a sudden I get a Skype call. Oh, I do a lot of coaching through Skype, and I figured, oh, somebody called me from Skype, and I just ignored it. And then they called again. I ignored it. And then I got a message. And then they called again. I'm like, what is going on? Well, I had a person I was working with going through the exact same situation, but he had a bigger account and a smaller liability. And he was still panicking, like, I don't know what's going to happen. I don't know what's going to happen. Well, I said nothing. They're going to assign you the stock. If you don't have the money required to buy it, T+3, right? Trade plus 3-day settlement. So the money's not due for 3 more days. It would generate a margin call. If you get a margin call, then you either A, have to put more money in your account, or B, they're going to sell the stock. Oh, okay. Well, you didn't want the stock in the first place. So yeah, sell the stock. In fact, and I think this might have happened with Amazon. It definitely happened with this guy. But by the time Monday came around, the stock was back up. And he made more money selling the stock higher than it was assigned to him at, excuse me, than he had on the original credit spread. And I'm pretty sure around that same time, the same thing would have happened. If he would have just had a conversation with somebody, apparently someone had gave me a comment that they never returned his calls. He would have been fine. Wouldn't even have lost any more money than he was already showing as an unrealized loss, just a realized loss at that point. If it was a little lower, you'd lose a little more. A little higher, you'll lose a little less. So it's a bit of a crapshoot, which, what does that mean? We don't want to do it. That's the first thing I'll say. So if you have a spread trade, let's start with that. Let me get a question answered, and then I'll come right back to this. Can I ask my broker to exercise an option I hold before expiration? And is there a penalty other than the regular fee? Great question. So let's start with that. Maybe. Most of the time, yes. Most options that we trade in the trading room, I'm not sure if Vlad does any index or not. I personally will do some index option trading. It depends on if you're trading equity options, which are stocks, or index options. So SPX, NDX, VIX, any of the indexes. If you are trading an equity option, they are American style. American style, I don't know if this is why, but the way I learned it when I was studying for the Series 7, American style is more freedom, right? Which means you can exercise anytime you damn well please. You want to exercise, you can say, I want it. There is absolutely no penalty or fee other than the normal fee for an exercise to do that. That happens around dividends. An index option, now remember, indexes don't have stock behind them. You cannot buy an index. So index options are what are known as cash settled. There is no delivery of anything other than cash. Index options are European style options, European style. European style options can only be exercised at expiration, not even on expiration day, at expiration. And then there's a cash settlement, and then that's the end of the option. So if it's an American style, so if it's a stock option, yes, you can go early. European style, no, there's nothing there for you. You got to wait until expiration. So if you ever are trading something where you're worried about early assignment, then you may want to look to do an index option instead of an equity option. No problem. Keep throwing your questions out there. Anything that's just one of those almost like seems like trivia in regards to options. But if you have a question, spit it at me. So let's start with spreads. We'll work our way back. We're going to do vertical spreads first. Then we're going to talk about long options, and then we're going to talk about maybe a couple of other strategies like diagonals or calendar spreads, which are time strategies. Okay. Let's start with credit spreads. With a credit spread, honestly, if it's going to the upside, I'm usually not going to be there, because if I get to 80 to 90% of maximum gain, I'm going to shut it down when it gets to that point, regardless of when expiration is. But if I happen to be there around expiration and I'm at that point, I am going to just let it go worthless, right? No problem. I'm not going to roll. It's achieved its objective. If my credit spread is making 80 to 90% or more, it's achieved its objective. There's no reason to do anything. I'm going to let it expire worthless. But if I get to 80 to 90% and I'm like 8 to 10 days before expiration or more, absolutely, I'm going to take that off the table. You've got the meat. You've got it. There's nothing left. There's hardly anything left but bones in the trade. There's nothing but risk. And one thing that I want you to think about as you get to the last week of an option, gamma risk. That might sound like something from a Hulk movie, but gamma risk is a real thing, right? Gamma is how sensitive is delta? How much will delta change? Delta is how much do I gain or lose as the stock moves. As time decays, as there's less time, I lose the cushion that it provides. When I don't have that time cushion, my options become much more sensitive to movement up or down. So if I have a trade that's got 2 days left and I'm close to the money and that thing goes against me, I could go from max loss to max gain in a couple of points. That's the gamma risk. I don't want to put myself in that situation if I can at all help it. If you are at or near expiration, or especially at expiration, and you are in the spread, which is the second scenario with the question market, right? So this is out of the money. What do? I don't have to do anything. I can let it expire worthless. But if I'm not real close to expiration, I'm probably just going to close the trade anyways. If I am 100% in the money at expiration, there's no reason to fear. You're already dead, right? It's already done. You've hardly, if you could try to scrape a little money out of the trade, maybe you try to, but at that point, if it's already gone that way, you're already in the money. It's done. You're done for. You're at max loss. You don't have to do anything. You can just wait for same day substitution and move on. But here, where I'm putting this little star asterisk thing, really ugly, I know, that's where we have to be the most sensitive. Because if you have an option that's in the money, it will be assigned to you, and the option that you own will be of no value to you. I would recommend you close the entire trade. There's no reason to try to roll at that point. Um, uh, uh, and here's the thing I'm going to stop and tell you, because the concept of rolling is an interesting thing. And people ask me all the time when we're working together, well, can't I just roll it? And they hear enough people who are like, oh, I'm just going to roll. I'm just going to roll. Rolling is starting a new trade. Just understand that. For you to roll something, you've got to close an existing position and open a new one higher, lower, or further. You can roll up and give yourself more distance. You can roll down and give yourself more downward distance. You can roll out and give yourself more time. But rolling is taking a loss most of the time. I'm going to say most because we'll talk here in a little bit about calendar spreads, and this is the one time where I would be open to the possibility of a roll. If you're rolling, you're going to have to sell what you own, take a loss, and buy something further out in time. I'm rolling out. I have an option that's good until April 16th, and I'm running out of time. I want to get to May. What do? I sell April, and I buy May. Well, May is obviously going to cost more than April, right? So it's going to be a debit. It's going to cost me more. I'm now into that trade for more money. It drives me insane because people make rolling seem like it's this magic strategy. Like, oh, all you got to do is roll it. Just roll it. What do you mean just roll it? You better assess what your risk is after the roll to see if that trade's even going to make you money. And if it is, how much? Because once you roll, you have a loss that you now need to overcome with the roll. So the roll better have the potential to get you there. So if you hear people flippantly talking about rolling, oh, just roll, be suspicious. Just remember what I'm saying. Be suspicious of that. There is no just. If anyone ever puts the word just in front of something in trading, be suspicious. Like, oh, just do this. All you have to do is this. There's more to it than that. You really need to assess what you're up against with that roll, and what the logistics are of the next trade. I've seen people roll themselves into situations where they literally can't make money anymore. They've rolled it twice, and all of a sudden it's like, I'm looking at the risk profile, and I'm like, you can't make money now. All you can do is maybe recover some money. And they're like, what? What do you mean? I'm like, yeah. So be aware of that. Ed says, roll, baby, roll all night long. If you're rocking and rolling, maybe. If you're rolling options, be careful. What if I roll for more credit? Now, that's a different scenario. And that would be rolling like a calendar spread, where what you're rolling is an option that has diminished. If you're rolling a buy, if you're doing a debit roll, it's more risk. If you're doing a credit roll, right? If you're doing a credit roll, then maybe, right? Then you're thinking about, so if I do a calendar spread, let's say that I did a June, April calendar spread. So I own June, I sold April, and here comes Friday. And I look at it and I can buy back the option that I sold, and I can go two more weeks out and sell another one, or 4 more weeks out and sell another one. Yes, that's a possibility, right? Now I'm going to buy back the option that I sold very, very cheap because it's almost to expiration. Then I'm going to sell one further out. So what would I roll for? A credit. So a credit roll is a very, very different scenario than a debit roll. And if you had to guess which one I tend to talk to people about, you probably could. Unfortunately, it tends to be debit rolls, which means they bought an option, it didn't work, and they're like, well, can I roll it? Right? Can I just roll this? Usually the question of a roll comes when you're losing money. So yes, you can roll something when you're losing money, but just realize that if you do that, you have to take a loss and then implement a new trade, and the new trade has to have the potential to overcome the loss you've already taken and then make you money. And if it doesn't offer you that, then you're better off knowing, just taking the loss, right? A trader once said, if I'm walking down the tracks and I see a train coming I get off the tracks. I'm not trying to roll the train. I'm trying to get out of its way. So selling, so I have a comment that said I sold a put, a 45 strike for $4. That is losing on Friday. MP. Let me just see what's going. It's expiring. Is it expiring out of the money? Ah, okay. So here's the deal. If you sold a 45, which is up here, for $4, you're going to have to buy back that option for $9, right? Because it's all intrinsic at this point. Let's say it was Friday today. You're going to have to buy it back for actually $11, right? It's now 11 points out of the money. So what you sold for 4, you have to buy for 11. Then you would have to see, can I sell something in May? So if you could sell the May 45 for $7 more, then at that point you could break even on the trade if it got back above 45. You no longer have any potential for making money. All you can do now is say, if it gets back above here, I'll break even. And that's what I'm talking about, right? That puts you in a very dangerous situation where you're just fighting to not lose. And so you have to be very careful. Rolling for even, so in that situation, even though there is a slight credit, there's still a very dangerous prospect, because at that point there's just simply nothing left. And I'd be surprised if it stays that way, because I think that option would not be selling in May for $7, maybe. But you can see that one thing that's happened down here, the volatility has fallen from 100% down to 85. So there's less premium down here now than there was back in this area, maybe when it was first sold. It was sold back here, and now you're selling here. You're getting significantly less money for the new option. That's what makes it hard. Now, if you were getting more money, that might make it a little bit more feasible. If you buy a call option and hold till expiration, will you have to buy the stock? Okay, no, you never have to do anything when you're buying an option. Remember that as a buyer, you have rights. Only sellers have obligations. So as a buyer, if you hold it to expiration and it's out of the money, it's worthless, there's nothing you can do anyways. If you hold it to expiration and there's some value but not all value, then you have to decide, do I sell it for the value I have, or do I exercise it to own the stock to see if the stock can get me back into a better scenario? But again, right, what are we trying to do there? We're hoping that it comes back, and hope is not a great strategy for when we're losing money. Okay, so credit spreads, we went through the 3 different scenarios. Debit spreads are a little different. If I have a debit spread, that means I'm buying the option. When I'm buying the option, if it's a debit spread, I'm a net buyer. So I do have an obligation, but my obligation is covered by the option that I own. So I'm really not in danger of being exercised. So let's, if I own, let's say I do a bull call spread instead of a bull put spread. Let's say I do it here on MP. Let's say I buy the 35 and I sell the 40. If the stock goes up above 40, both options are in the money. And I could basically go through same day substitution where I'm going to exercise my option and then use the stock that I buy to sell it to this person. So I buy the stock at 35. I then sell it to the person here at 40, and I make $5. Again, I really don't want to go through all that. I would rather just sell the option for the $5 or sell the spread for the $5. There's no reason to roll, just get out of the trade. If it drops below, they're both out of the money. And if they're both out of the money and we get to expiration, then they're both worthless. So what do I do? Nothing. I don't have to do anything. I'm taking max loss, so I hope we didn't do that. We just put on a couple of credit spreads today. Let me see if I can pull one of these up. Let's take a look at a credit spread on NEO. Not a credit spread, a debit spread, sorry. So here is a debit spread. We are here, right? We want this stock to go up. Hopefully it goes up above 43. If it goes above 43, I could hold it till expiration in order to get my maximum gain, which is up here around 1,300, 1,200, something like that. If it drops, the most I can lose is the cost of the trade, right? Which is 400 bucks. I cannot lose more than the cost. Anytime you have a debit in an option trade, you cannot lose you cannot lose more than you put into the trade. But let's say that at expiration, so let's go through this at expiration. This is where I want to be here. Anywhere this way, I'm at maximum gain at expiration. I don't have to do anything, but I would prefer to go ahead and sell it. In this case, I would sell it for $2, right? That's how much it would be worth. $2. I paid 50 cents for it. So paid 50, make $2, 3-to-1 on my money, no problem. I don't want it to be under 41. That's where we are now. If it's under 41 and I let it go to expiration, I lose everything. The question is, what happens if it is in between? That's when debit spreads have the need for us to do something. So let's say it's right where this dotted line is, 42.45. If it's at 42.45, the option that I bought, the 41, has intrinsic value. I'll make money. The option that I sold is out of the money. It'll expire worthless. So I can leave it and get exercised and buy the stock, or I can sell it basically for, in this case, if it was this line, I would be able to sell it for $1.25. That's a 2, 125. It's not maximum gain at $2, but at least I'm getting out of the trade. Oh gosh, that was so bad. That's a 2. Try drawing with a mouse. It's not easy, I promise. Last week we did a May $18 call on Macy's, which is losing at the moment. Okay, so if you just simply buy a call, what do we do with it? So it's an out of the money call for May. You have plenty of time. I mean, the trend is still good. I actually have been watching Macy's. I think Macy's looks pretty good. I still feel okay about it. Today was a weird day, kind of came down, went back up. But overall, what do we see here? Higher low, higher low, higher low, higher low, higher low. Now, sometimes it makes these crazy whipsaws up and down like we did here and here. If you saw something like that happen and it gets to the top, I would close it. Bam. That's it. I'm done. Because the last thing I want is to watch it right up here, then fall back down here, and then grind sideways again. And then you start thinking, oh, I should have got out here. If it pops up to this level up here, that option would be worth at least $3. I don't know what you paid for it, but probably not $3. When would we need to roll? So let me talk about when rolls are advantageous. When we're doing time spreads, which would be like a diagonal spread or a calendar spread, when we buy further out in time so that the time decay against us is slow, and then we sell short-term chunks to decay. If I can ever roll those short-term options for a credit, it's beneficial to do so. Because what that means is I'm buying back the option that I sold at a cheaper price, then I'm selling the next option for more. And the more I can roll for a credit, the more I'm paying down the initial cost of the option that I bought. And eventually, at some point, I'm going to sell that option. And hopefully the stock has been either moving higher and adding value to it, or even staying the same. And as it stays the same, if I keep selling additional options, I'm going to be paying that down in order to have a gain. So that's the time when rolling options really makes a lot of sense. If you're doing covered calls, right, which is a diagonal. If you want to know what a diagonal spread is very similar to a covered call. But instead of owning the stock, I own a longer term option. Some people just naturally assume leaps and they say, oh, it's covered calls on leaps. It's not a covered call unless you own the stock, but it's a similar prospect, right? Where I have control of the stock, whether I own the stock or I own an option on the stock for a longer period of time. And then I'm looking to sell short-term premium against it. More of a slightly bullish strategy. A calendar spread, which I love trading calendar spreads. I need the volatility to drop just a little bit more, but when it does, I'll definitely be trading those. More of a sideways strategy. And with a calendar spread, if it's just kind of grinding sideways, then I'm looking to sell, a couple weeks out. And if I can roll it when it gets close to expiration, what that means is I'm going to buy back the option that I sold, hopefully at a much cheaper price, and then sell the next option, which means I'm rolling for a credit because the next option that I sell will be more expensive. So that's probably the best guide you can use for rolls. If you're rolling for a debit, that means you're taking a loss. If you're taking a loss, then in that scenario, whatever you're rolling to needs to have the potential to overcome the loss that you've already realized. It's a realized loss, and then still make you money. If it doesn't have that potential, then you're probably better off just taking the loss and moving on. If you're a swing trader, you should be right or wrong within 7 to 10 days, right? Most of the trades that we put on are swing trades, which means if they aren't going right, then you need to simply close the trade. Do I primarily do put calendars or does it not matter? That's an interesting question, Ed, and the answer is yes. I actually do primarily put calendars, but it doesn't technically matter. If you look at a put calendar versus a call calendar, theoretically, they're going to look very, very similar. Same delta, same theta, same vega, everything like that. I prefer put calendars for a couple of relatively obscure reasons. So if somebody did a call calendar and I do a put calendar, I'm not going to say, oh, I have an advantage over them. It's very rare that I would actually ever need to utilize one over the other. So good question. It's the same with butterflies. I tend to do call butterflies and put calendars. But if you built the opposite of one or the other, they're going to look almost completely identical from a theoretical standpoint. So if you look at the Greeks and how you would expect them to behave, almost identical. Great question. Here's another one. But if you are exercised on an in-the-money short call against a long option, you end up short the stock while holding the long-term call. Okay, so you're talking about an early exercise, right? An early assignment. So yes, you're right. So theoretically, if I had a bear call spread with an in-the-money short leg, and all of a sudden there's a dividend, there is a chance that the stock gets assigned early, right? Or if I have a bull put spread that with an in-the-money option, there's a chance that it gets assigned early. It's a very low risk proposition, but it does exist. And you're exactly right. I mean, there's really nothing you can do about that if you haven't, except maybe if you have a rule that says if it goes in the money, I'm either going to try to close the trade or roll the trade immediately. However, I think you would be taking steps that are not that necessary. Here's what I want you to ask yourself. How many options have you bought? And this is everybody. How many times have you exercised them because they were in the money? Early, especially, right? how many early exercises have you done? I haven't done any. I'm not interested in owning the stock, right? It's that simple. So it is a risk, but it's not a big risk. And yeah, there's really not much we can do in that environment because, you could look at, well, do I exercise the option now? You would have to look at the margin requirement of whatever the exercise led to and just kind of, again, try to figure it out. Long options. Let's talk about long options and rolling. If you are buy an option and everything goes well and it's expiration and you're still bullish, then there's another scenario where you might decide to roll it. I would rather roll to another option than buy the stock personally. I'm not interested in tying up that capital. So if that was the scenario, that would be the one time that I would be thinking, okay, let's go ahead and sell, right? Because if you sell, you're actually taking a profit and then you're buying another option. So if you sell the option that you own and you buy another option, there is a debit there, but if that option starts to drop and you get out, you've already booked a gain on the first one. So in that case, rolling out in time can make sense. But to be honest, I would probably roll out and roll up. Because if I had a trade that went well in my favor, I'm going to be deep in the money. I'm not interested in buying a deep in the money option going forward. So I would take profit on the in the money option, and then I would go out further and buy at or out of the money again and kind of start the whole process over. So yeah, the questions you need to ask yourself are, is the trade still valid? But that's a question you would be asking yourself anyways as a management question. If the trade's not valid, then you should be exiting the trade. That's actually one of my personal trading rules. If the original reason for getting in the trade is no longer valid, get out. Don't buy more time and be like, oh, well, maybe I just need more time. What do you mean you just need more time? If it's wrong, it's wrong. If it's crossed the line in the sand, it's crossed the line in the sand. Now you're just trading on hope. So if hope is your motivation for your roll and you're losing money, which means you're rolling for a debit, it's wrong. That's my opinion. It's wrong. If you're rolling for a debit because the trade is working and you're looking for it to work more, great. If you're rolling for a credit, great. Now, when we're deciding whether or not we should close, we need to think about what are the likelihoods. What is the likelihood? What is the likelihood of expiring in the spread versus expiring in the money or out of the money? On a credit spread, if it's expiring out of the money, you don't need to do anything. If it's well in the money, you also don't need to do anything. One's max gain, one's max loss. A question came in that says, does Tradespoon have a service that only one kind of spread is used? I don't think so. I mean, I know I will build both types of spreads, both debit and credit and calendar. I don't think Vlad does calendars as much as I do. I think he'll do both credit and debit spreads as well, just kind of determined by the type of trade, the amount of time we expect to be in it, what we're looking for by way of strikes and things like that. At what loss would you get out? That's a tough one, Carol, because for me, it's not necessarily a loss amount, but am I wrong on the trade? So when I'm getting into a trade, I'm going to have I should have a trend, I should have a consolidation, I should be at or near a support or a resistance level, and usually I'm going to be wrong if it breaks that support or resistance level. That's when I'm wrong. I want to quantify how much I'm going to lose. The debit spreads that we just put on, I'm figuring about a 50% loss, right? About a 50% loss if it goes wrong. So if I look at, let's say, Boeing, if I look at Boeing, And I'm into the trade for about 500 bucks. I'm thinking I'm wrong around 250 or so. If it drops down, gets to this level, I lose about 250. That's where I'm wrong. Ish on this one. And this would probably be wrong earlier. So there it is right there. If I'm right, I have the ability to make anywhere from 600 to 1,000. If I'm wrong, I'm risking about 250. Okay, right? That's 3 or 4 to 1 on the trade. Actually, I think it was only like 200 at risk, more like, but that's what I'm looking for is 3 to 1, 4 to 1 if I can. It's a fairly aggressive, but I knew that because it's an out of the money debit spread. So there it is, right? Every option. This is when I first saw the title of this presentation, I'm like, oh my God, like that's like there's not a matrix with a set of rules. Every trade's a little bit unique, and we have to ask ourselves, number one, are we still right, or is the trade starting to go wrong? If I rolled, how much time would I need? Am I rolling for a gain or rolling for a loss? I don't roll for losses. That's my general rule of thumb, right? Traders got to live by a code. That's my code. Don't roll for a loss. That's just basically like buying more, right? Essentially. So if you're going to roll for a gain or roll in an already profitable situation. So roll for a gain if you're rolling for credit, roll for more time if you're already in a winning trade, but you've run out of time. That's a good problem to have. Other than that, I would say be really, really careful, eyes wide open of exactly what's at stake if you're going to roll for a loss or a debit of any kind. Other than that, you need to be very aware of what it's going to look like at expiration. Am I going to am I in the money? Am I out of the money? Am I in the spread? Because where you are relative to the spread is going to make absolutely a difference. If you're going to hold a spread until expiration or hold an option until expiration, be aware of gamma risk. If you notice this trade I have that just is getting going, my gamma is very, very small, not even 1. If I take this trade to the day before expiration, that gamma gets a lot bigger, especially around the money, right? Right around in this area here. And I can see a trade go against me dramatically, right? You can see the gamma here is 12 times bigger than it was. So, and again, if you've never done it, the characteristics and risk of standardized options that I mentioned is along some of these same lines, right? If some of these logistics that I'm talking about with exercising and assignment is not that familiar, you would definitely benefit. You would definitely benefit from having access to that. But if you're going to trade options, be aware of what are the logistics around expiration. The horror story from that Robinhood trader, it breaks my heart to this day. But it's not that surprising, right? Like I said, I saw a grown man, business owner, savvy investor panicking with a larger account and less liability because he wasn't sure what was going to happen when that stock got put to him. Once he had a sense of it, no problem. But that can be a scary thing. So make sure you understand what the logistics of expiration look like based on the type of trade that you have. There tends to be a lot of varying opinions as to what delta to purchase for a debit. How do you determine which delta options you buy? Haha, there really is. You hear a lot of people say delta of 0.7. And I say, why? And they're like, because it's bigger. Okay. Delta is not a measure of quality. None of the Greeks measure quality. They just measure behavior relative to changes in underlying variables. How much is my option going to gain or lose based on price? How much is it going to gain or lose based on volatility, vega? How much is it going to gain or lose based on time, theta? They don't work in a vacuum. So I'll be honest with you. If it's higher volatility, yeah, buy a bigger delta because it'll offset some of the increased time decay. In a lower volatility market like we're getting into now, I have no problem buying out of the money options, because remember, if I have if someone buys a 0.75 and I buy 3.25s, we both have 0.75, and I actually paid less for 3 out of the money options than they did for 1 in the money option. Now, what's the disadvantage? I will lose more in time decay, right? So if it takes 3 weeks instead of 1 week, it will hurt me. But their option can only grow from 75 to 100. Mine can grow from 75 to 300. So I'm going to have a bigger gamma. I'm going to have greater potential for my trade to grow in my favor. So even with that question, there's no right answer, right? There's like, well, are you more interested in gaining more in the beginning or gaining more at the end? If I gain more at the end, it will cost me a little more in time decay. So I have to ask, am I willing to make that sacrifice? Yeah, it's interesting stuff. What I would say, make sure you have a very sophisticated pricing model to help you quantify these things. I don't know how I would trade without having something like this that allows me to see quickly gains and losses with these what if scenarios. So great questions. I hope this helped give you just some insight into some of the things that you're up against as options traders. I sometimes take for granted. I actually, interestingly enough, had this discussion a couple of times in the last week where people were like, oh, wow, I didn't realize. And so hopefully that was the case. So you put time in the coconut and shake it up. I'm okay with that. If I have a nice trend and a good move, I'm willing to go forward with it. Absolutely. So anyways, I gotta run. I appreciate you guys taking an hour of your afternoon and spending it with me. I hope I was able to impart some good tidbits of options your way. And if so, then join me in 2 more weeks when we do this again. And if there were anything that we talked about, if you ever think, oh, the Greeks, I don't know the Greeks. I mentioned this recently. If you go into the archives of the Active Investor Workshop series, we had a really good discussion on the Greeks earlier this year. Go take a look, watch it, enjoy it. Other than that, I hope you enjoyed the rest of your day and week. If you're on the inside of Tradespoon and you're going to join me tomorrow for the trading room, I'll see you then. If you're just kicking the tires a little bit on Tradespoon and you're saying, hey, I want to see what you guys are all about. I believe we're all about good trading, right? Which means we're not talking about flashy this or that, but just good trading principles, understanding the types of trades you should build, understanding risk, reward. That's how Vlad trades. That's how I trade. So if you're thinking about it, jump on in. I think you'll enjoy what we have to offer. What time tomorrow? The trading room tomorrow for me, Vlad's at 8:15 Central Time in the morning, 15 minutes before the market closes. I am the last hour of the day. I get to shut the thing down. So if you have that in your wheelhouse, then come on in and join us. Thank you again, you guys. I appreciate your time, your energy, and as always, would like to wish you all very happy trading.